Hi, this is Lara at Elliott Wave Gold with an extra video update for you after the trading session Monday 16th of May has ended. At the beginning of this week, the picture is not as clear as last week. The main wave count was expecting stronger upward movement than what we've been getting. We've been getting mostly sideways and slow upward movement for the last 5 days. It's really inconclusive. Stepping back and having a look at the weekly chart level, I am very concerned that the alternate could be correct. While price has not broken above 1303.51 to confirm the main wave count, there is a very real risk remaining that the alternate could be correct, and as I have kept stating to members for the last week or so, that risk remains at 1237.97. At this stage, members should have profitable positions to the long side for gold. You may want to consider moving your stop up to break even, or possibly, depending on how long you like to hold a position, taking profits. At the maximum, stops should be set just below 1237.97 because that's the risk to long positions with the wave count. Let's have a look at the weekly chart. From this high to this low for the entirety of the bear market, I'm seeing this as a supercycle A wave subdividing as a double zigzag. Importantly, this is the only structure that I can see fitting into this bear market which meets all Elliott wave rules. I am aware that other Elliottians have wave counts which see an ending diagonal beginning here. I'm seeing it begin here. If you see an ending diagonal from this high to this low, it violates an Elliott wave rule. You would have 1, 2 and 3 would be longer than 1, but 4 would be shorter than 2 and 5 would be shorter than 1 and 3. So the diagonal should still be contracting and the trend lines still converge, but the problem with any wave count that sees an ending diagonal from this high to this low is the third wave within it is too long. That violates the rule regarding wavelengths within a contracting diagonal. For a contracting diagonal, the third wave should be shorter than the first wave. So there's a solution. If the first wave begins here and the fifth wave ends here, and now the ending contracting diagonal meets all Elliott wave rules. We have a zigzag for 1 and 2 and 3 is a zigzag which is now shorter than 1. 4 is a zigzag which is shorter than 2, and 5 is a zigzag which is shorter than 3 and has a small overshoot of the 1-3 trend line. It meets all rules and it looks very typical. What that all means is supercycle A will only fit as a double zigzag. We have a 5-3-5. The first zigzag in the double ends here. It's the two zigzags in the double are joined by a shallow brief zigzag in the opposite direction. I have no problem with the brevity of the supercycle wave X. X waves within double zigzags are usually very brief and shallow. This fits perfectly. It has a very typical look. And now we have a 5 expanded flat for the 3 and an ending diagonal for the 5. So we have a double zigzag ending down here. I have not been able to see another solution for this bear market at this stage which meets all Elliott wave rules. I will not publish again any wave count which violates any rules, although I have published the possible idea of the diagonal beginning here with the statement that it did violate that rule. I don't want to go back to that. If supercycle wave A is a double zigzag, there are a couple of important implications. It means that grand supercycle 4 can't be a multiple. We can't relabel this double zigzag supercycle wave W because you cannot have a multiple within a multiple. The maximum number of corrective structures within a multiple is 3. To label multiples within multiples increases that maximum beyond 3, violating a rule. That's a really easy way of telling if you should give any weight to an Elliott wave count or not. It's the biggest, most common mistake made by those new to Elliott wave, labelling W, Y and often Z as well with W, X, Y, X, Z within them. If you ever see any labelling like that, don't take any notice of it. Its implications in terms of projecting what should happen next are not going to be of any use because it's not following Elliott wave rules. The rules are black and white. And so if we've got a multiple ending here, it's a 3-wave structure. We can't be looking at a bigger multiple for grand supercycle 4, so that narrows it down to either flats or triangles. Within a flat correction, there's a minimum requirement for the B wave. In this instance, supercycle wave B would have to reach 90% the length of supercycle wave A. I think that price point is 1833.71. There's no minimum requirement for a triangle though, which means that there is no absolute minimum requirement for supercycle B, because grand supercycle 4 could be a triangle. For both a flat and a triangle, the A wave has to be a 3-wave structure. A double zigzag is termed a 3. The B wave has to be a 3. And for both an expanded flat and running triangle, the B wave can move beyond the start of the A wave, so we could see a new all-time high for gold above 1920.18 as part of this B wave. When the length of the B wave is known, then the type of flat or triangle would be known, and a target down for C could be calculated. That can't be done yet. A new movement at supercycle degree should have a pretty clear 5-wave structure up at the weekly chart level. While that's unfolding, no second wave correction can move beyond its start below 1046.27. There are more than 23 possible corrective structures this B wave can unfold as, but the most likely structure would be a zigzag or a zigzag multiple to achieve the depth that this B wave would most likely require. Doesn't have to be that though, so once we get the first 5 up complete, we're going to start to have alternate ideas at the weekly chart level, and it will start to get really confusing. For now, let's look for a 5 up. Let's see the end of supercycle A, this point down here. From this low to this high at the daily chart level, we probably have what looks like a pretty good complete 5, and here we might have the end of the following correction for an intermediate degree second wave. If intermediate 2 is over here, it subdivides nicely as a double combination. We have a zigzag X triangle, and it may have ended here. This could be where minor wave 1, the start of intermediate 3, has ended, and minor 2 is either over here or it could continue lower. I still have 2 hourly wave counts, the first looking at minor 2 complete down here, and the second looking at it continuing lower. That second hourly wave count for this daily chart does remain viable, and that is exactly why risk remains at 1237.97. Only a new low below that point would tell us this wave count is wrong at the daily chart level, and then we would be using the alternate. If intermediate 3 has begun here, then at 1477 it would reach equality in length with intermediate wave 1. If that target is wrong, it's not going to be high enough. I've used that ratio though because here intermediate wave 2 is remarkably shallow, and so that would be the appropriate ratio if this is where intermediate 3 has begun. To the upside, if we see a new high above 1303.51, I will consider this wave count confirmed, and it would then be the only wave count at the daily chart level. Let's have a look at the first of 2 ideas at the hourly chart level. The first one sees minor 2 over here, this point down here, and minor 3 beginning at 1367. Minor 3 would reach 1.618, the length of minor 1. Within minor 3, I still expect the first wave is incomplete. It's possible we could move the degree of labelling here up 1. This could be minute 1, but I really would expect it to have lasted longer than just one small day. And so if minute 1 is incomplete, then we have 1, 2, 1, 2. I've adjusted the labelling within this piece of movement. Now the sideways chop looks like either a double zigzag or a double combination, and this labelling sees all of the subdivisions have a really neat fit. We have either a 3 or a 5, a 3 for B, a 5 for C, so we have A, B, C. This is either a regular flat or a zigzag, a quick 3 in the opposite direction, and now a 5, 3, 5 zigzag ending down here, which slightly deepened the correction beyond the end of the first, but mostly moved sideways. So minuet 2 could be a double combination. It could also be a double zigzag. The second zigzag and the double could have deepened beyond the end of the first, but at this stage, so long as the subdivisions within here fit, it really doesn't matter. It's a double, and it's probably over here. And the important bits, this is a 5 down, and a 3, 3, 5 here fits perfectly. From this low to this high, this has a fairly good fit as an impulse, and from this high to this low, so far this looks like a deep zigzag. I've drawn a base channel around minuet waves 1 and 2, draw a base channel from the start of 1 to the end of 2, place a parallel copy on the end of 1. The third wave should have the power to break through the upper edge of this base channel. We've got an overshoot here, but price quickly returned back in. If we get more downward movement, it should find support at the lower edge of this base channel. If this second wave correction here for subminuet 2 is complete as labelled, then downward corrections should find support at the lower edge of this base channel drawn around subminuet waves 1 and 2. If this trend line is properly breached, then subminuet 2 is probably not over here. It certainly could continue lower as a double zigzag, or this could be just a three-wave structure for the A wave within it. It could be a sideways and lower, more time-consuming correction. If this trend line is breached, here's the next line of support. Subminuet 2 may not move beyond the start of 1 below 1263.36. Invalidation of the wave count at the hourly chart level would put some doubt on it at the daily chart level, but it wouldn't fully invalidate it. To the upside, this is the target for minor 3. Let's have a look at the other idea where this low could be just a B wave within a triangle, and so minute A is seen ending at the same place on the daily chart, and here we may have a running contracting triangle still unfolding for minute wave B. The angle of entry into an Elliott wave triangle should be the same direction as price exits the triangle. So here minute wave A moves lower. Let's quickly go back to the daily chart and I'll try and make that a little bit clearer for you. So for the second hourly chart, we have A ending here, and now A, B, C, we need D and E for a sideways moving triangle. The triangle would have begun here, and we would have an expanded flat for A, zigzag for B, ending down here, this point here, and now a zigzag up for C, a zigzag down for D, and a zigzag up for E. If C continues any further, it can't move beyond the end of A above 1295.34. For a triangle idea for minute wave B, that is the final upper invalidation point. It can't be moved any higher. And so a new high above that point would give a lot of confidence to the main hourly wave count. This idea expects choppy, overlapping sideways movement for another 2 or 3 days to complete a triangle, to be followed by a sharp downward thrust. That sharp downward thrust for minute wave C can't move beyond the start of minor 1 below 1237.97. At the daily chart level, this wave count is identical to the main wave count up to this point here, and now we're still looking at the possibility that what if intermediate 2 is not over, what if it's going to be a more time-consuming and more typically deep second wave correction than the main wave count expects. We could have an expanded flat correction for intermediate 2, a three-wave structure for A, a three-wave structure for B, which is a double zigzag. We need a five-wave structure down for C. At 1183, C would reach 1.618, the length of A. Expanded flat corrections are very common structures, and their B waves very typically convince us that the correction is over because they make a new price extreme beyond the start of the A wave. This wave count is entirely viable, and this week it has some support from on-balance volume at the weekly chart level that should be taken very seriously indeed. I'm a bit concerned at the mucking around for the last few sideways days, and so now I'm going to look at the possibility that minor C is an ending diagonal. For it to be an impulse, I had labelled it 1212, but this is just too deep and time consuming. So what if it's an ending diagonal? They're actually fairly common structures, and so the end of a zigzag down here for minute 1, and here we have a 535 zigzag up for minute 2. If it continues any further, it can't move above 1303.51, and that right there is exactly why the main wave count requires a new high above that price point before we can have some solid confidence in it. While price remains below this point and above this point, both wave counts will remain valid and the picture will be unclear. An ending diagonal requires all of the subwaves to subdivide as zigzags, including the third wave. The third wave has to move beyond the end of the first wave. The fourth wave has to overlap back into first wave price territory. Contracting diagonals are the most common variety. This second wave correction is between the normal depth of 0.66 to 0.81. It's 0.67, the depth of the first wave. So the subdivisions all fit and the depth is normal. This is entirely possible, and it could explain this choppy overlapping movement we've seen for the last few days here. The target at the hourly chart level is the same as at the daily for the same reason. Let's have a look at the weekly chart for some classic technical analysis. I've gone back over a year and a half and I've looked at what happened with volume and on-balance volume for this rally, this one, and this one. And now we're looking at this one. When we look at volume, the situation isn't clear. This rally here saw volume overall increase. These 3 days decreased, and maybe at the high, the increase in this week was part of a volume spike on the final day. That could be possible. Back here, on-balance volume broke above the upper edge of a small consolidation zone, and that told us we were going to get more upward movement. So this was more reliable than volume bars at the weekly chart level. It's really difficult to see the consolidation zone around here, so I've drawn a resistance line here and a support line here. Back here in this week, we got a warning that price was probably going to move higher. It made a new low first, which was rather confusing, and then it made a new high and it did move up. But I have this in Elliott wave terms as an expanded flat, and so this as a B wave makes sense. There was something wrong with it, and there was huge divergence there between price and on-balance volume. Here's a good consolidation zone on balance volume, and we had downward movement in this week, broke below the support line, and that was an important breakout that preceded quite a lot more downward movement to the final low down here. During this bear market rally, it was upwards weeks which had strongest volume, and particularly these 2 weeks saw price move strongly higher on increasing volume, but price ended the rally and turned around to make new lows, so the volume bars for this rally were not reliable. On balance volume here was reliable. Looking at this rally, we saw overall declining volume toward the end of it. As price moved up, overall volume moved lower, and strongest weeks were downward weeks, so that did indicate the direction of price after the rally was over. But because it didn't work here, I don't think it's very reliable. So I'm not going to give any weight to volume bars at the weekly chart level, but I will give quite a lot of weight to on-balance volume at the weekly chart level. In every one of these instances, where the orange line is resistance and the purple line is support, the direction from on-balance volume preceded the direction from price, or at least a break below support was followed by more downward movement from price, and a break above resistance was followed by more upward movement from price. We've got a nice little consolidation here from on-balance volume, and this week here we have a break below support that should be taken very seriously, and that is the biggest, strongest reason why risk remains at 1237. There is a very real risk to long positions that they could be stopped out. Price could turn around and move strongly lower for a few weeks. Take that seriously. Looking at the daily chart level, I will give weight to volume bars. We have overall sideways movement for a small consolidation. It looks like a small pennant pattern. They're usually a pretty reliable continuation pattern. So prices entered the pattern upward. We would expect it to exit the pattern upward. But that supports the main hourly Elliott wave count and is in opposition to what on-balance volume is telling us at the weekly chart level. Up until a few days ago, it looked pretty clear that price had been consolidating. It had broken out on this day with a stronger upward day, or a strong upward day on increased volume. As price was rising, volume was increasing. I said to expect a throwback to find support at one of these lines. It initially found support around the upper line, and now it's finding support around the lower line. but it's failing to move away quite clearly, which you would expect it to have done by now, and prices overall drifting sideways with narrow range days, and it's coming on declining volume. Now, this up to here still looks like we should be expecting an upward breakout, but I'm concerned the on-balance volume is telling us at the weekly chart level to expect a downwards breakout. ADX is still flat, telling us the market's not currently trending. It hasn't told us there's been a trend change. The positive DX line remains above the negative. ATR is declining to flat, agreeing with ADX. The market is not currently trending. On-balance volume at the daily chart level is constrained within this green and blue line. A break above the green line would be a bullish signal at the daily chart level from on-balance volume, but I would still, if that happens, give more weight to what on-balance volume is telling us at the weekly chart level. So it wouldn't be a strong enough indicator to have confidence in the main wave count. We need price to do that above 1303. To the downside at the daily chart level, if on-balance volume breaks below this blue line, that would be further bearishness. I would then swap the alternate around to the main wave count and very firmly expect more downward movement. We're not there yet. So there's a very real risk to long positions at the beginning of this week. That's all for me today with your gold analysis. I hope that all of our members had a most fabulous weekend.